Hello, everyone. My name is Ken Leon, Director of Equity Research with CFRA. I would like to welcome you to today's webinar on Amazon and disruption in retail and logistics. Joining me today are three of my colleagues and esteemed equity analysts. We have Tuna Amobi, Head of the Consumer Sector Strategy, including Internet Retail, Jim Corridor, Head of Industrials and Transportation, and Camila Januszewski, Equity Research Analyst responsible for the retail and textiles, apparel, and luxury good industry. Before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we will do our very best to answer as many of these questions as we can. For our agenda, over the next hour, my colleagues and I will discuss CFRA's views on Amazon with a focus on retail and logistics, including areas where the company has demonstrated market leadership. We will review the e-business of logistics and why Amazon sees this area as so strategically critical and how incumbents are competing in the era of Amazon. We will also showcase CFRA's analysis of certain categories and companies within the retail segment and their positioning given Amazon's broad dominance, including the companies that are the most and least vulnerable and why. A couple slides related to about who CFRA is, our history, and our research team and capabilities. You can see here on the next slide 5 that the history of our firm goes back over many decades. CFRA founded in 1994, S&P back in 1927 for the global equity research businesses. CFRA was acquisitive in 2007 when CFRA first sold Risk Metrics and then MSI, and then they acquired it back in 2013. Things got really exciting October 2016 with the S&P Equity and Fund Research business acquired by CFRA, and team members today on the call are from the equity research team. So today, we're one of the largest independent research firms with over 75 investment professionals and growing. Very complicated chart, but one that really highlights CFRA's advantage. We have integrated solutions like the rest of providers. We are a power user in terms of data from information providers. We also have working relationships in our coverage with company management, and we're industry experts with many years of experience. Leveraging analytics and data, we are able to provide customers large coverage, so enormous scale, and we're able to do research in that way or offer to customers security selection, idea generation, and risk monitoring. The real advantage for us, though, is what we do on the left side of this slide. The ability at the bottom to drive research and insights in our scaled coverage of 11 sectors and 68 industries. We have our renowned equity research stars recommendations on 1,500 plus companies, global. And we have a winning 1,300 ETF coverage on a unique high-performance methodology. Our capabilities at CFRA is also always verification and deep dives of the analytics. We have a recognized position in terms of forensic accounting, legal, earnings, and cash flow quality. And all the time, we are having our expertise and dialogue with our customers, as we're going to be doing today from our professionals. Moving next to our proprietary methodology, it is an engine. It enables us to blend fundamental equity with forensic accounting. It is unique in the marketplace, and it is distilled in a variety of different output or published, such as market commentary, which is weekly, sector and industry research, ETF and mutual fund research, company research, which is the foundation for all of our practices, both equity and forensic, portfolio risk monitoring and modeled portfolios, and at the very bottom, thematic research, which is driven by differentiated idea generation. Finally, with this overview, CFRA, why use us? We are 100% independent. This is all that we do, which is fundamental research. CFRA does not manage money or make trades. Many independent investment research providers claim to be free of conflicts, but they're not. We are 100% free of conflict by doing research. And with that, let's move on to today's presentation, Amazon's Evolving Logistics and Supply Chain, from Tuna Omobi. Good morning, Tuna.
Good morning. Thank you so much, Ken, and thanks everyone for joining us today. So as Ken alluded to, I'm going to talk about Amazon's evolving logistics and supply chain. And this presentation, the next few minutes, I'm going to touch on three main areas. I'm going to kind of give a backdrop of e-commerce growth, and I think it answers the question of why so much focus on logistics. And I'm going to talk about how Amazon's logistics and supply chain strategy has evolved over the last several years, and they have evolved quite significantly. And lastly, I'm going to kind of touch on why we like the stock. Amazon, we have a current buy recommendation on the stock. So just a quick recap of our investment thesis. So moving on to the first part of the my presentation, e-commerce has been growing very rapidly. I think this chart kind of tells a very good story, both as to why e-commerce has been outgrowing overall retail sales, as well as significantly outpacing. On the chart on the right, you see the growth compared to overall retail sales. On the left, you see the line chart. E-commerce is on a very secular, strong secular growth trajectory, which we expect to continue, significantly outpacing, the overall brick and mortar sales. The next slide will give even more context as to why we think Amazon is the preeminent player in that U.S. as well as global e-commerce space. Left chart last year, 2018, Amazon alone accounted for more than 40% of the overall e-commerce growth in 2018 in the U.S. On the right side of the chart, the line chart shows the trajectory of Amazon's market share in e-commerce. The top line on the right side is the U.S. portion. So notice that the trajectory shows e-commerce share for Amazon growing from 38.1% in 2016 to projected 52.4% by the end of this year. So this year is expected to be a tipping point. Think about this. Amazon, by the end of this year, will account for more than half of each dollar of e-commerce sales in the U.S. So that's what it's telling. It's quite compelling. The bottom section shows the global e-commerce share for Amazon. Obviously, there's other big players in there as well, but I think the trajectory, nonetheless, continues to show that the company continues to eke out e-commerce gains around the world. The next chart, I think we'll touch on some of the major strategic milestones for Amazon over the last several years, right? And you'll see how the company has proactively and aggressively kind of launched its own delivery initiatives. I think I'd like to think about the 2013 Christmas delivery fiasco, which, as some of you might remember, UPS and FedEx were kind of overwhelmed by logistical challenges, and there were a lot of disappointed folks during that season. Amazon was actually forced to make some refunds and gift cards to disappointed customers. Shortly after that, as the second bullet shows, I think the company made a very conscious decision to launch its own, logistics last mile delivery network. Following that, they've made a number of other aggressive moves to ramp up their own delivery and logistics infrastructure. So going down that list, in December 2015, they deployed thousands of Amazon Prime branded trailer trucks. And then I think it's quite interesting, the last bullet on that page, in February 2016, the 10K of Amazon for the first time identified the company as a transportation service provider. Moving on to the next slide to recap other strategic milestones. The top bullet there, in first half 2016, Amazon made a decision to lease about 40 cargo planes. That number is growing as we speak here. In January 2017, they made a very bold $1.5 billion investment in an airport cargo hub. I think that was in Cincinnati, Kentucky area. So again, that was a very strategic move. February 2018, that was a very bold move when they decided to launch shipping with Amazon. This is a parcel delivery service that's meant to signal seriousness in perhaps competing with UPS and incumbent FedEx. And then just last month, the last bullet on that page, I thought Amazon for the first time added transportation and logistics companies among its potential competitors. So again, signaling that they are very serious in this space to get in a competitive mindset. Moving on to the next slide here, I think this is quite telling in terms of how Amazon's logistics spending have ramped up significantly over the past decade. So I think what this chart shows is, as we sit here today, more than a quarter of Amazon's net sales are actually reinvested in terms of logistics, comprising shipping and fulfillment costs. So look at that. I mean, over $60 billion of spending in logistics. I mean, that's huge by any measure. So I think that kind of shows how the company has been ramping up this cost. And remember, when we talk about net sales, that number includes Amazon Web Services, which if you exclude that, the percentage numbers go up even higher. So we're just talking about logistics spending to aid the infrastructure business here. That's what we're talking about. So I think moving on to the next slide, Amazon's logistics footprint in North America have expanded quite dramatically. I think this kind of chart shows in terms of the square footage and the facility locations in North America, kind of shows active and current and active facilities in development. And again, if you kind of just go back a few years, you'll see that this number has risen quite exponentially. And I think the Whole Foods acquisition kind of added to that as well. As you can see, they're adding aggressively airport hubs and other facilities just to kind of make themselves much more closer to their customers. The next chart, next table, Amazon's logistics footprint around the rest of the world. Notice that there's a fair amount of concentration in Europe and Asia Pacific. But what I take away here is that if you look at the square footage, it's only a tiny fraction of the North American square footage. That's why we think Amazon has tremendous international opportunity as it ramps up its fulfillment and logistics around the world. So they were a little late getting started in some of these international markets, but that is just getting started. Expect that to ramp up significantly over the next few years. And then the next chart, we want to talk about third-party sellers and how they drive fulfillment. For those of you who are not aware, third-party sellers are those independent sellers that kind of use the Amazon platform for their own transactions, where Amazon would be responsible for fulfillment. These sellers continue to own inventory, but Amazon will ship them to the customers based on their customer orders. These sellers are very high margin business for Amazon, and because Amazon literally, most of the profit drops to their gross margin. And that's why a major reason we see gross margin expansion for Amazon. Now, this chart says that third-party sellers have been growing in terms of percentage of paid units on the Amazon platform. This year, last year was 53%, so already more than half of paid units on Amazon. And I think the takeaway here for this chart is that the growth in these third-party sellers have been a major reason why, a notable catalyst for Amazon's fulfillment by Amazon service. The FBA service is a very popular service that is among these third-party sellers and other merchants as well. So continued growth in here has kind of helped to justify the fulfillment and logistics investment that Amazon has been making over the last several years. Now, the next chart shows the benefit mostly used by Prime members. Now, I wonder how many people on the call would have guessed that free shipping is by far the most popular feature on Amazon platform. And by the way, this was based on a recent survey by S&P Global Market Intelligence. So it's quite telling that free shipping, even more than Amazon Prime Video, is the most popular feature. And you go down that list, you see Prime Now, which is the number 5 most popular feature. So this kind of tells you how much significance that shipping has and helps to rationalize why Amazon has been investing aggressively in shipping and logistics, including the free shipping to even non-Prime members for the first time we saw last holiday season. So I think expect this to continue to be a major focus as we kind of look out for the Prime subscriber base. And then lastly, on my own side, I've got a slide to show our Amazon investment thesis. So we have a current buy recommendation on the shares. Our 12-month target price is $2,000. And the potential catalysts that make us to like the stock, we've already alluded to the e-commerce leader and the market share gains. We'll touch on Prime membership growth. Right now, they've got well over 100 million global Prime subscribers and growing very fast. The economics of Prime members are quite superior to non-Prime members, so they can justify a lot of the investments they're making just simply because it makes Prime membership much more attractive. Cloud computing services, AWS, which has been the fastest growing division in Amazon, the cloud infrastructure business, which is now becoming a $30 billion run rate business, margins north of 30%, growing upwards of 50% a year, which we think this unit alone accounts for almost half the value of Amazon itself. And then the hardware devices, the voice-activated devices, the Echo and Alexa line of devices, that is also a very huge addressable market where Amazon is really gaining share, international expansion, multi-industry disruption. So we're talking about retail and logistics today, but as some of you know, Amazon has been quite disruptive in a number of other areas, whether it's the drugs retail, whether it's banking, a whole lot of areas where the company has literally upended the traditional competitor, the incumbents. And then lastly, on that page, I kind of highlight shipping and logistics as a next potential catalyst. I would say that while the jury is still out, it certainly seems to us that shipping and logistics will be the next frontier for Amazon, perhaps the next competitive battle frontier. So this is kind of a recap of our investment thesis. At this point, I would like to turn it back to Ken to move it along. Ken?
Thanks, Tuna, for that interesting profile on Amazon. And now we're going to shift gears and look at the competitive landscape. Jim Corder on impact of logistics incumbents. Good morning, Jim.
Thanks, Ken, and thanks, everybody. So Tuna laid out a very compelling argument on Amazon being a disruptor in many sectors. Of course, it's a powerhouse that's benefiting from e-commerce growth. We're going to gently rebut some of the comments and explain why we don't think that Amazon is a threat to the logistics space in terms of FedEx and UPS. But before we do, I'm going to start out with my overall outlook on the air freight and logistics sector, a 10,000-foot view, if you will. We are very positive on the space. Tuna did lay out some very compelling statistics on e-commerce growth. We think that's driving strong volume growth for players in this space. Online sales are well outpacing overall retail sales. Tuna has some statistics for you. I have some as well. 2018 holiday sales rose 11.5%, outpacing 2.9% growth in overall holiday sales growth. And for 2019, online should well outpace overall retail sales as well, with 10% growth forecast by the NRF. On top of the volume increases that these carriers are getting from the strong e-commerce growth, both UPS and FedEx both implemented about 5% rate increases in January of this year. They tend to implement rate increases annually, and they're getting pretty good traction on that because the demand environment is so strong. Some other things that explain why we are positive on overall e-commerce growth. Demand is supported by the U.S. GDP growth, which has remained strong, and consumer confidence remains very high. So that's the left side of this chart. On the right side is a little chart that shows where air cargo revenue ton miles, which is how fast package growth is on the air cargo side of the business. And the chart is gently sloping upward to the right, which indicates that we are seeing growth. You look at that little dip towards the end of 18 into the beginning of 19, we saw less holiday restocking, we think, because holiday sales in general were a little disappointing, although e-commerce growth was very strong. But in general, the things are moving upward and continuing to grow nicely on the air cargo side of the business. Moving on to the next slide. If you look at the equity performance of the air freight and logistics sector versus the S&P 500 over the past year or so, it has underperformed. We think that worries about Amazon have been one of the most compelling reasons why these stocks have underperformed. And we think as investors come to understand that FedEx and UPS are not threatened necessarily by Amazon and they're more of a partner, that these stocks can do very well this year. We also think worries about infrastructure costs. These companies have had to make some investments in order to increase capacity because of the sheer number of volumes that they're getting weighed on the stocks. And we think worries about global trade wars with China, treaties with Mexico and Canada, those kinds of things also weighed on this sector last year. And with some hope and optimism in recent news flows, we think that can drive some outperformance in the sector as well. Moving on to the next slide, we're going to talk about specifically Amazon related to UPS and FedEx. It's important to note that neither FedEx nor UPS list Amazon as one of their top customers, not more than 5% of revenues for either of the companies. FedEx's largest customer is actually the U.S. Postal Service, and there is some Amazon revenues in there because they do act as a facilitator for the last mile deliveries for the U.S. Postal Service in many cases. So Amazon is in at 3%. If you add a little bit extra from their overall Amazon revenues, we think Amazon in general is about a 5% of FedEx's overall revenues. And UPS, we think it's also about 5%. So we consider Amazon to be a growth driver for these companies and not a core threat, because even if they lost 100% of the revenues from Amazon, there would still be strong revenues for both of these companies from other sectors other than just Amazon's e-commerce growth. So the biggest threat we see from Amazon is not necessarily to FedEx or UPS, but to some other logistics providers that are smaller in scale and could be more hurt by the loss of an Amazon business. XPO Logistics is one of those. We're going to discuss that a little bit later in the call. The one caveat being that an Amazon logistics acquisition would be a game changer and would make them much more of a threat. So we think they need to scale up significantly if they do want to play in this space. Look on the right side of this chart, look at overall FedEx and UPS revenues versus Amazon's global shipping spending in 2017, 2018. You can see that the two companies combined are much bigger overall than Amazon's total spend. And of course, as I laid out, they do not spend all that money with UPS or FedEx at all anyway. So moving on to the next slide. Could Amazon compete in the logistics space? Certainly, Tuna laid out a lot of the investments that Amazon has made in fulfillment. But could Amazon actually be a competitor to FedEx and UPS? We think that would be a very capital intensive, very complex technologically, and would take many years to play out. And we think that Amazon would rather spend its dollars on higher margin business opportunities. If you look at FedEx's overall asset base, $53 billion in infrastructure, including hubs, planes, trucks, and everything needed to fulfill packages throughout the globe. And 2018 CapEx of $5.6 billion, 670 aircraft, 12 million square feet of sorting and handling facilities, over 2,000 facilities. This is much larger than Amazon's global footprint at this time. 100,000 vehicles, 320,000 employees dedicated just to taking a package and shipping it from point A to point B. UPS has a similar footprint with $50 billion in assets and 481,000 employees, just dedicated mostly to package delivery alone. Moving on to the next slide. So Amazon is seeing its shipping costs rise. Tuna laid that out as well. Their costs are up 15 times over the past 9 years, while their sales are up only 7 times. So they do have to do something to combat these costs. But if you contrast their logistics infrastructure with FedEx and UPS, 50 planes versus over 1,200 for the combined carriers, 20,000 vans versus over 100,000 trucks at each of the companies, so 200,000 in total. And they have 120 fulfillment centers, which was a huge investment for them. But there's over 4,000 facilities worldwide for FedEx and UPS. So we think that because of the sheer scale of the needs to be, if you want to deliver a package to anywhere on the globe, we think the threats are a little bit overblown with the challenges to make this kind of a network. We think overwhelmingly the most likely scenario for Amazon is providing overflow capacity when they can't get enough capacity to deliver their packages. Doing the last mile, they made a significant acquisition in the last mile delivery, which tends to be big bulk packages. And same day in large cities where the economics make much more sense, leaving logistics thesis intact for the rest of the world, more rural areas, more spread out areas. Moving over to the next slide, this is a little visual representation of what we're just talking about on the last slide. Total aircraft, FedEx and UPS versus Amazon. You can see it's a huge disparity. Stocks on FedEx and UPS moved hugely to the downside when Amazon announced the leasing of 50 planes. But it's not even 10% of what the other carriers have, and it's not a threat. If you look at the vehicle side of the business, it's a similar picture: 20,000 trucks for Amazon versus nearly, over 200,000 for the other two companies. So we don't think it's a huge deal. So moving to the next slide, to whom is Amazon a threat, though? So like I said earlier, even the total loss of 100% of Amazon's business wouldn't cripple FedEx or UPS. They would be able to offset that with growth in other regions, other types of retailers, shipping parts to manufacturers, legal documents, everything that they've done for years, they will continue to do. But we do see Amazon threat to other types of shippers, and these would be third-party logistics providers that are smaller, more dependent on one single customer, and Amazon obviously is the 800-pound gorilla in shipping packages. Dedicated truckers who are shipping to and from warehouses, ports, and airports, and do tend to do a lot of the fulfillment for Amazon, and companies that do warehousing and other types of fulfillment business, as Amazon has entered the space in a big way. And we also see a mild threat to passenger airlines, which tend to ship packages and mail on the belly of their planes, keeping, adding a little ancillary revenue stream for them. But that's a marginal impact that could happen over time. More importantly, the threat that Amazon could create would be, next slide please, would be, could Amazon make a significant mergers and acquisition in the space, which would allow them to scale up in a way that would allow them to compete? We think an acquisition of FedEx, it could be possible, would be a huge game changer and would change the entire thesis that we have for the logistics industry. Number one reason is that FedEx is cheaply valued relative to Amazon and relative to its own historical valuations. It's currently trading at 11 times forward earnings, 5.3 times forward EBITDA, and 0.7 times sales, which are all well below their historical averages, with its forward PE actually well below the S&P 500. So even at a huge premium that it would take to acquire the company, we think it would be an attractive acquisition that would be very accretive to operations. FedEx also largely non-unionized. They use an independent contractor model for a lot of their fulfillment. It fits very well with Amazon's performance-based, efficient culture, where they're also relatively anti-union, I would say. It solves Amazon's scale problem logistics. As you see, 50 planes is not going to be enough to cut it if you want to deliver to everywhere in the world, and would change our entire thesis on Amazon's threat to the logistics space. However, we do note that FedEx is fiercely independent and would likely be resistant to a purchase. I'm not certain how that would go. It might have to be a hostile takeover, and I'm not certain that would be something that would be possible, but it certainly is interesting to talk about. Moving on to the next slide, UPS, we think, would be a much more challenging acquisition candidate. The company is largely unionized, 59% Teamsters, plus pilots are in the union, and mechanics related to planes are also in the union. Their pension plan is also $8 billion underfunded, which would be something that would have to be addressed at some point. We do see the stock as attractively valued, but we note that it does trade at a much more expensive valuation than FedEx at 14 times forward earnings, 9 times forward EBITDA, and 1.2 times sales. We do have a strong buy on the stock, which we'll probably talk about more in a few minutes, but the reason for that is that we do think that global logistics trends are positive, and we also see the stock as very attractively valued relative to its historical valuation, relative to the S&P 500, but less appealing than FedEx because of the valuation. It also has a structure that will make it much more harder for an Amazon to acquire the company, with Class A shares having 10 votes per share, and those shares being concentrated in director and officer hands for the most part, which then those directors and officers will be much more likely to vote in alignment with what UPS wants to do rather than what might be best for shareholders. So we think that would make it much more difficult for an acquisition to go through. Moving on to the next slide, talk about our overall recommendations in the logistics space. Number one, C.H. Robinson, we have a hold on. This is a relatively smaller carrier that has a huge customer base, a third-party logistics provider that doesn't own assets. While we do like the space that it's in, the company does have a drag on its overall operations from its exposure to fresh produce business. It has a sourcing business in that space, and that's been a huge drag on its company margins. So we have a hold on that stock, even though we're positive on the fundamentals and the rest of the business. Look at Expeditors International. This is a company that we think could be a beneficiary of Amazon pulling its business away from XPO, which we're going to talk about in a minute. They don't break out their largest customers. We do think Amazon is not that significant to them right now, but could be in the future. They are also a third-party logistics provider that does a lot of fulfillment, a lot of logistics, a lot of air and ocean freight forwarding. They are very globally diversified, and our whole recommendation is largely because they are exposed to some weaker growing areas in Africa and emerging markets that's a little bit weighing on their performance of late. Looking at FedEx, we do have a strong buy on the stock, as we already discussed, compelling valuation, strong execution and financial performance, and strong e-commerce trends all underpin our #1 thesis for why you should buy this stock, and with this new M&A overlay representing an actual additional attractive feature as well. We'll go to the next slide. Landstar System, we have a strong buy. They are a relatively smaller third-party logistics provider that does not own a lot of trucks. They source capacity and get that capacity to where it needs to be through brokers and sales agents. We consider them a very well-run company that's a strong, consistent generator of revenue and EPS growth. And their numerous customer relationships with over 50,000 clients keeps their risk of Amazon relatively low, with no customer more than 4% of their overall revenues. UPS, strong buy, based on, like we said, e-commerce trends, attractive valuation relative to historical levels, and excellent generator of cash, which it uses to buy back stock, pay a dividend that's well above its peers, and return to shareholders with strong CapEx investing in their products at the same time. And finally, XPO Logistics, we recently downgraded this stock to hold. They recently lost a huge business with Amazon. Amazon was by far their #1 customer with $900 million in annual business. Amazon's pulling 2/3 of that business away this year, and they're likely to lose the rest of it. Amazon has made a big purchase in last mile, which is where XPO was a big player with Amazon, and now they will compete on that space. And XPO itself might be trying to compete in the fulfillment space against Amazon directly, which is also weighing on the stock and is leading to Amazon taking their business away, in my opinion. So that's a good wrap-up of where we think about the space, and I'll turn it back over to you, Ken.
Thanks, Jim. Great overview on air freight and logistics opinions. And now we're going to pivot and talk about the retail markets, winners and losers in different addressable markets where Amazon is a disruptor. And with that, let me turn it over to Camilla Januszewski. Good morning, Camilla.
Thanks, Ken. Good morning, everyone. My name is Camilla, and today I'll be speaking about Amazon's disruption in retail. Who are the winners and who are the losers? Next slide. We decided to quantify the level of disruption by looking at Alexa Internet's share of voice data. If you look at the slide in front of you, you'll see the formal definition that Alexa Internet provides. To illustrate with an example, let's say a user is on a major search engine like Google and types in the word appliances. Share of voice would show the percentage of traffic that ends up going to jcpenney.com, sears.com, bestbuy.com, amazon.com, and so forth. We grouped Amazon's level of disruption into 3 categories: low risk, medium risk, and high risk. If Amazon.com had a share of voice greater than 10%, we deemed that to be high risk. Between 4% and 10% to be medium risk, and less than 4% to be low risk. Some categories that we looked at were sporting goods, home furnishings, computer and electronics, and office and school supplies. We bucketed those categories under high risk. Jewelry and accessories we found to be medium risk, and beauty and cosmetics, apparel and footwear we found to be low risk. Next slide. Let's start off with the first high risk rated category, sporting goods. We have a negative outlook on that category, even after the bankruptcy of Sports Authority and the rounds of consolidation activity that largely began in 2016. The industry continues to struggle. Retail sales were down 5.8% last year. And alongside the decline, Amazon has launched a handful of private label nutrition brands, its own sportswear lines, and also sells fitness equipment under Amazon Basics. Next slide. To start off with our share of voice analysis, you'll see that we looked at the keyword sports deals on the left and fitness equipment on the right. On this slide, and also on the coming slides, You'll notice that we code Amazon.com in yellow and the market leaders we'd like to highlight in red. Looking at sports deals, Amazon's share of voice stands at 23.5%, while Dick's Sporting Goods stands at 18.8%. For fitness equipment, Amazon's share of voice stands at 11.1%, while Dick's Sporting Goods stands at 19.2%. Next slide. Alongside Amazon's expansion efforts, Dick's Sporting Goods has seen declining returns on capital, gross margin deterioration, and waning comparable store sales. We attribute the declines to three primary factors. One, broad-based industry softness, which we mentioned in the previous slide. Two, Dick's Sporting Goods decided last year that they would be phasing the lower margin hunt and electronic segments. And while those segments are lower margin, they do draw foot traffic in and drive the purchasing of higher margin categories. And three, larger challenges that Dick's Sporting Goods is facing adapting to the online retail model. Dick's Sporting Goods has tried to update their e-commerce capabilities. They recently launched ship from store. They recently launched buy online, pick up in store options. But in our view, those efforts aren't paying off enough. Nevertheless, we have a hold rating on Dick's Sporting Goods, and that's reflective of opportunities we see for Dick's Sporting Goods to become a more focused, higher margin business. We see the headwinds from the phasing of the hunt and electronic segments largely phasing out and contributing to gross margin expansion beginning in fiscal year 2021. And we also really like what Dick's Sporting Goods is doing with expanding their private label footprint. It currently accounts for about 14% of sales, and in the next few years, we see that going to 20%. On their earnings call a few days ago, Dick's Sporting Goods said that they'd be phasing out Reebok and also introducing their own sportswear line. And last, what we really like that Dick's Sporting Goods is doing is they're revamping their presentation experience. In the stores where they've already phased out the hunt and electronics, they're putting in batting cages, and they plan to put out other experiential offerings, not just in select stores, but stores nationwide. Next slide. Another high-risk category I'd like to highlight is home furnishings. We have a neutral outlook on this sub-industry. The retail sales were up 3.5% last year, and we forecast that they're going to be growing at a low single-digit rate this year, driven by higher mortgage rates and also a shortage of attractively priced homes. We think both these factors will contribute to more people wanting to renovate their homes and remodel. In terms of what Amazon is doing in this space, earlier this year, Amazon rolled out Amazon Showroom. Amazon Showroom is a visualization tool that lets consumers replicate their bedrooms or replicate their living rooms from home and put furniture in different areas. So if they want to put a dresser here or a lamp here, it helps them make their online furniture purchasing decisions. Amazon's also been launching their private label furniture brands. The most recent one they launched in October of 2018, and that was Ravenna Home. Looking at share of voice, Amazon's cookware share of voice stands at 22.9%, compared to Williams-Sonoma's 16.9%. Now, Amazon sells cookware, soft furnishings, dining utensils. It's all under their Amazon Basics private line. Next slide. Looking at Williams-Sonoma, it caters to a different demographic to an extent than Amazon. Williams-Sonoma caters to the upper class, higher end consumer. However, e-commerce accounts for about 52% of Williams-Sonoma's revenues, and as such, their business model is at risk from Amazon's expansion efforts. In terms of risk, we see higher risk for the kitchenware categories, the soft furnishings, and less risk when it comes to furniture, just because of the supply chain costs involved with the delivery. And also, we see brick and mortar to be a competitive advantage. We have a hold rating on Williams-Sonoma, And that's because of several initiatives that they have in place that we see driving future momentum. First, we like that they're optimizing their store fleet. We like that they're focusing on improving conversion rates through investments in augmented reality and technology, rolling out similar features like Amazon Showroom. And we also like that they're driving cost efficiencies in their supply chains through trying to achieve full vertical integration. Next slide. Another high-risk category we flagged was computer and electronics. We have a negative outlook on this sub-industry. Even after the bankruptcy of Circuit City and H.H. Gregg, the industry is struggling. While retail sales were up 1.9% in 2018, that's quite low and lagging the larger retail landscape, which posted a 5% gain. In terms of what Amazon is doing, they offer electronic accessories under Amazon Basics. And earlier this year, they announced the acquisition of Eero, which is driving Amazon's gains in the smart home connectivity category. For those who don't know, Eero is a home mesh router manufacturer. Looking at share of voice, some keywords that we examined were laptop and electronics. Amazon's laptop share of voice stands at 13.5%, compared to Best Buy's 16.4%. Amazon's electronics share of voice stands at 9.3%, compared to Best Buy's 1.1%. Next slide. To compete with Amazon, Best Buy has attempted to shift to a more service-oriented business model. The company recently launched Total Tech Support, and they also recently acquired Great Call. On the merchandising front, Best Buy has introduced buy online, pickup in store features. Despite these initiatives, we have a sell rating on Best Buy, primarily for three reasons, challenges that we see in fiscal year 2020 and beyond. First, we see headwinds as Apple expands its distribution network. Apple is a key vendor for Best Buy. Additionally, we see challenges in the computing and mobile phone category. That category accounts for about half of Best Buy's revenues, and we believe U.S. demand in that category is approaching oversaturation. According to a recent Pew Research study, 95% of U.S. adults own and use cell phones, while 77% claim to own or use smartphones. The same study that Pew Research put out in 2016 largely had the same numbers, which in our view indicates stagnation. And last, smart home. Smart home was one of Best Buy's best performing categories this holiday season. And we see this category at risk as Amazon makes market share gains with its acquisition of Eero. Next slide. And the final high-risk category I'd like to highlight is office and school supplies. We have a negative outlook, and that negative outlook is on the brick-and-mortar players. According to NPD Group, brick-and-mortar office supply retail sales were flat in 2018. We see this largely due to Amazon's aggressive push to secure contracts with public schools. Those contracts used to belong to the traditional players like Staples, like Office Depot. Recently, Amazon announced that they secured new agreements with Atlanta and Denver public schools. On this slide, we also highlight a survey which just shows how popular Amazon is in this space. According to the survey, Amazon ranks as the #1 shopping destination for office supplies, while Staples ranks #4 and Office Depot came in #5. Next slide. Looking at share of voice, two keywords we looked at were office supplies and school supplies. For office supplies, Office Depot's share of voice stands at 33.3%, while Amazon's stands at 10.1%. Looking at school supplies, Office Depot's share of voice stands at 21.8%, compared to Amazon's 12.2%. Next slide. To compete with Amazon, Office Depot, similar to Best Buy, has attempted to shift from a service-oriented business model. In our view, their efforts are not paying off enough. Now, Office Depot groups their services under the Business Solution division. So that includes the copy and print services, and it also includes the recent acquisition of CompuCom. Now, if you look at how that division is performing, in the most recent fiscal fourth quarter, if you net out the acquisitions, sales were flat. If you look at their other division, which is the retail division, that's where you're getting those traditional office supplies, and that division, in our view, is the most susceptible to Amazon's expansion efforts. That division continues to struggle. Comparable sales were down 2% in 2016, 5% in 2017, and 4% in 2018. Now, earlier this year, Office Depot did announce a collaboration with Alibaba. That collaboration would create an Office Depot on Alibaba.com and would also give Alibaba access to Office Depot's distribution and store network. However, from our analysis, we believe that Alibaba is that partnership's primary beneficiary, and we see meager opportunities for Office Depot within it. Next slide. A medium risk category that we highlighted is jewelry and accessories. We have a neutral outlook on that sub-industry. The U.S. Census Bureau groups jewelry and accessories in the larger clothing and clothing accessories category, and sales within that larger industry are up 4.8% last year. In terms of what Amazon is doing, they have something called Amazon Collection, which is a private label, mainly fashion jewelry assortment, and prices are generally under $100. Also in 2018, Amazon filed a trademark for a jewelry brand that's supposed to be called For Keeps by Amazon. And in 2017, Amazon launched its own private label handbag line. It's called The Fix. Next slide. Looking at share of voice for jewelry, Amazon's share of voice in jewelry stands at 8.8%. And we also highlight some other industry players. Tiffany's, where share of voice is 6.5%, Kay, where share of voice is 3.7%, and Jared, where share of voice is 3.4%. I do note, though, that Amazon's assortments are fashion jewelry, while Tiffany's and Kay's and Jared's are largely focused on fine jewelry. And for accessories, you'll note that Amazon's share of voice stands at 4.2%. We've highlighted the victims. Now on to our survivors. First, cosmetics. We have a positive outlook on this sub-industry. You can see that retail sales are up 3.6% last year. And we see that industry maintaining strength despite Amazon's expanding focus. In terms of what Amazon is doing, earlier this year, Amazon launched its first private label cosmetics collection. It's called The Find. It's only available on Amazon's UK site for now, and it has everything from mascara to eyeliner to eyeshadow. Prices are generally under $20 and very much comparable to market leaders like ULTA, like Sephora, department store counters, and also to an extent drugstores. In terms of why this industry is maintaining and we see to maintain strength, its competitive advantage is product sampling and experience, which the pure play online retail model we believe and we don't see providing. To highlight a survey by Global Data, nearly 4 out of 5 millennials today say they enjoy experimenting with foreign products. Next slide. If you look at share of voice, 2 keywords we highlight are skincare and makeup. For skincare, you'll see that Ulta's share of voice stands at 7.7%. And that compares to Amazon's 0.7%. If you look at makeup, Ulta's share of voice stands at 15.1% compared to Amazon's 1.5%. Next slide. We have a buy rating on Ulta Beauty, and what we really like about the company is just how innovative they are. They have the premium brands, they have the prestige brands, and they also stock those indie brands, which you're not going to find anywhere else. By indie brands, I mean those independent vegan brands that they get from independent manufacturers. We're also really impressed by the strategic partnerships this company has formed. They have a partnership with Kylie Jenner in lips and Kim Kardashian in fragrances. And with those partnerships, they've been able to launch some very high-profile product presentations. We also note that Ulta is investing in augmented reality and artificial intelligence, which we think is going to position them very effectively in the future in this field. And they're also one of the only retailers today that are actually opening doors. They're opening about 100 stores a year, which is really unique considering the amount of store closures that were announced in the larger retail landscape earlier this year. And last, we really like their focus on earnings growth and higher returns on capital. They're focused on driving cost efficiencies and returning cash back to shareholders. Next slide. Another survivor we'd like to highlight is apparel and footwear. We have a positive outlook on this industry, and as I mentioned, since jewelry and accessories are also included in this industry, retail sales were up 4.8% last year. This industry is really interesting because from the categories that I've mentioned, it's been the industry we believe that Amazon has been most focused on penetrating. Over the years, Amazon has launched over 100 apparel and footwear brands. But from an analysis that we did, those private label apparel and footwear brands, they lag in customer satisfaction to the traditional national branded products. In terms of competitive advantage, it's similar to the beauty and cosmetics industry. It's the product sampling. Stores let consumers touch and feel products. So as soon as you buy a product, it's that instant satisfaction that you can feel it and it fits on you. That's why we believe that the odds for these apparel and footwear, the retailers, the manufacturers, it's in their favor because they have that brick and mortar presence. Next slide. Looking at share of voice, Amazon's closed share of voice and its shoe share of voice stands at 1.1% and 1.2% respectively. And with that, I'll pass it back on to Ken for questions.
For Amazon Prime membership and how that's driving the shipping and innovative offerings.
Yeah, thank you so much, Ken. So I think two of the most popular offerings in terms of appealing to Prime members with the shipping would be the Prime Now, and which is essentially 1 to 2 hour delivery in certain cities. It's being rolled out around the world. And you saw from slide 18 that Prime Now is among the top 5 most popular benefits for Prime members. And also there's also same-day delivery, where you can literally get millions of items shipped to you the same day. So this is taking those offerings to a new level of convenience. And that's why we think Amazon is using shipping to kind of cement its value proposition to Prime members, which, as I indicated earlier, have very superior economics compared to non-Prime members.
Jim, top of mind, of course, is the Boeing situation with 737 MAX, and how is that going to be impacting logistic companies with this issue?
Yeah, I don't think there will be any major impact on FedEx, UPS, or many of the other logistics providers. They don't tend to fly 737s. They tend to fly larger freighters that are 777s, 767s, and 747s. So those are not the MAX offerings. So there shouldn't be any grounded planes that really handle cargo. Airlines that are impacted, it's very small, only 350 planes globally, worldwide, that are being grounded right now. So airlines shouldn't see any kind of restriction in the number of packages that they deliver for other logistics providers as well. So it should be a non-issue for this sector.
Camilla, at the beginning we talked about CFRA capabilities on analytics and depth in terms of looking at data and coming with insights. Can you talk a little bit about the risk ranges, high, medium, and low, and how you went through that process?
Yeah. First, the categories that we highlighted in the presentation today, like sporting goods, home furnishings, those are just some of the categories that we looked at in a larger in-house analysis. In the in-house analysis that we did, we looked at everything from home improvement to lawn and garden to drug retail to pharmaceuticals. And in that larger analysis, we looked to see where the numbers congregated. And from there, we were able to determine the 4% and 10% range. Another factor that we looked at was also qualitative. We looked at how do these companies refer to Amazon in their earnings calls and in their annual reports? Where are they positioned in the space?
Great. And Tuna, one of the questions is about their position related to outside the U.S. One of the charts, it wasn't clear whether they are growing double digit and who potentially could be competitors for Amazon.
Yeah, sure. So outside of the U.S., the e-commerce landscape has, I'd say, a much more concentrated. So you've got, obviously names like Alibaba and others, which are just as formidable. So I'd say that the competition, internationally is a little more intense. Amazon has going for it the fact that Prime membership is just getting traction in international markets. I think Asia Pacific has been identified as one area where there is more opportunities for long-term growth. So the short answer is that we see more runway internationally compared to the U.S., where I think it's fair to say that in the U.S., Amazon is the predominant force, market leader. Internationally, it's one of the major players as well. But we see the pie growing as well internationally, because a lot of these markets, remember, the broadband penetration is still relatively low. So you could say there's more secular tailwind for e-commerce growth around the world compared to the U.S.
Jim, two-part question. Profiling FedEx, UPS. For Amazon, for acquisitions, could there be a tier 2 company? And there was also interest of learning a little bit more about your XPO recommendation.
Sure, yeah. I mean, Amazon could make acquisitions along similar to the size and scale that they did with their last mile business. It's a niche part of logistics that could give them core capabilities to expand within cities. We don't think that there are any major tier 2 providers out there that are on Amazon's radar right now. To give a little bit more context on XPO, XPO was a huge provider of last mile and other types of shipping services for Amazon. Amazon grew very irate with them after they hired a key executive away from Amazon in order to operate their own fulfillment business, and that's a key reason why Amazon pulled away a big portion of their business. When that happened, when XPO announced that they were losing this Amazon as their customer, they didn't name Amazon, of course, they just said their largest customer. The shares came under heavy shorting pressure, and as a result, XPO decided to shift their strategy away from making acquisitions and to using their cash to buy back stock in order to kind of stock it to the short sellers at the same time as supporting their own stock. So that's created kind of a Herbalife situation here for XPO shares right now, heavily shorted, and XPO trying to buy back as much stock as possible to support the stock. It's a battle that's going to play out over the next year, and as an investment, we don't really want a part of it.
Last question, Camilla. How can retailers stay relevant in the age of Amazon?
Sure. So two things. One, we recommend retailers to focus on experiences and customization. I mentioned how Dick's Sporting Goods is placing batting cages in select stores. We see that driving traffic and driving comparable store sales momentum. Another great example is Nike. Nike has a customization wing in their flagship stores where people can come in and design their sneakers with different fabrics and decals. That's a great strategy. Additionally, in addition to the experiences and customization, we actually recommend retailers to partner with Amazon. We think that's a strategic imperative in order for them to maintain market share. To highlight a few players who are doing this, Nike has a collaboration with Amazon where Amazon sells Nike's merchandise And in return, Amazon is removing that merchandise that Nike has on their site that's being sold by unauthorized resellers. Additionally, Best Buy, which we highlighted also in our presentation, they recently announced a partnership with Amazon with respect to smart TVs and Amazon's Fire TV and Alexa offerings. And to highlight an example in the apparel space, Carter's, which is a children's apparel manufacturer, they have a private label that they sell only on Amazon. It's called Simple Joys. And from an in-house analysis that we did, we found that that was the highest rated private apparel and footwear label that Amazon has. Also, the partnership allows Amazon to bundle Carter's products, so it's selling at a significantly higher price point than it would at carters.com.
Oh, great. So on behalf of the team at CFRA, we'd like to thank you for joining us today. Within the next day, you will receive a note from us with a link to the replay and slides from today's session. For those of you who subscribe to our Market Scope Advisor platform, therein you'll find many of the analysis that we covered today and much more. If you're interested in learning more about Market Scope Advisor, please visit our website, www.cfraresearch.com, to request a trial. Should you have any other questions, please don't hesitate to contact us at cservices@cfraresearch.com. Again, thank you and have a great day.